All right, let's start, guys. Okay, so we are doing your chapter number 3, which is your credit risk management, or book number 2, which is your credit risk. And in this chapter of credit risk management, right, we have your two modules, right? All right, two modules. Module 1 is about your credit risk policies and credit asset classification. Module 2 is about your loan loss provisioning and your credit risk assessment. Okay, so again, uh, please understand credit risk is one of the most important risks for the banks. Whenever you think about credit risk, think about a bank's balance sheet, your assets, your liabilities. Assets are your loans which are given to the customer. Liabilities are your deposits from the customers. The bank's main business is to lend money and earn interest, right? So what is the biggest danger here? The biggest danger is what if the borrower does not repay, right? So that is your credit risk, right? That is your credit risk that we have to understand, and we are talking here about the credit risk management, right? Uh, Again, please understand very carefully here is that uh, in this chapter, right, we'll focus on your how banks create your lending policies, control your risk exposures, monitor your loan portfolios, classify your asset, identify your bad loans, your non-performing loans. These are the foundation of your credit risk management. Okay, so that is what we are focusing here. So that is what it is: credit risk policy, credit asset classification, and we'll also look at loan loss provisioning and credit risk assessment. Okay, all right. With this background, let's start, guys. So in the module 1, right? Module 1 is your credit risk policies and credit asset classification. So we break this into your topics. Topic 1 is about elements of an effective lending policy. How should a bank design its lending rules? You should think of this as the rule book for giving loans. Then we have topic number 2, which is about your setting exposure and concentration limits, which is how your banks must control how much risk they take. If a bank lends too much to one company or sector, risk kind of increases. The bank sets limit there. Then topic number 3 is about lending policy and credit risk reduction. The banks try to reduce your risk using your collateral, your guarantees, your covenants, your credit derivatives, etc. Topic 4 is about review of loan portfolio. They check whether is the borrower still healthy, are the financial deteriorating, is the industry declining. This is called your credit monitoring. Topic number 5 uh, is about review of your bank's policy, right? That we need to understand, review of the bank's policy. Okay. So even the lending policy itself must be reviewed because market change, your industry change, your reputation change. So policies must adapt. And topic number 6 is about your credit asset classification, which is about loans are classified into categories. For example, in India, we have standard loans, substandard loan, doubtful loans, loss loans, right? These this classification helps banks understand which loans are risky. And topic number 7 is about your non-performing loans. A non-performing loan is basically a loan becomes your non-performing loan when payments kind of stop. In India, loan are overdue for 90 days. Those are your non-performing asset. This is extremely important in your bank risk management. And if you look at your connection to other FRM topics, this module connects directly to your expected loss model, your credit portfolio risk, your credit war, credit migration models, your Basel capital requirements. So this model is kind of this module is kind of the foundation, right? That we need to understand. Okay. So this was just the introduction, guide. We have to go into each topic specifically in detail, right? Now, when we are going into the first part, which is the elements of an effective lending policy, so we look at the credit risk and the bank failure. Credit risk is also called a counterparty risk, meaning the other party may fail to fulfill your obligation. For example, bank lends your 100 crore, borrower goes bankrupt, bank cannot recover your money. This is your credit loss. Important thing to understand here is that credit risk accounts for your 70% of bank's balance sheet because loans kind of dominate your bank assets. So if your credit risk is poorly managed, bank failure becomes highly likely, right? So example is your Lehman Brothers collapse, your Indian PSU bank, NPA crisis, etc. Right? When you talk about your effective lending policy, A good lending policy explains how loans are created and managed. Think of it as a step-by-step credit process. The policy must cover origination. Origination is basically your loan creation, right? Bank collects your financial statement, your business detail, your credit history to give the loan. Then about appraisal, which is your credit evaluation. Bank analyzes your income, your cash flow, your leverage, your industry risk. This is called your credit analysis. This links to another FRM topic which we'll study is the probability of default estimation ahead. Then we have the internal supervision. Banks, risk manager check are loans approved properly, are limits respected, are risk escalating. This is a risk governance. Then we have the collection procedure. What happens if the bank or if the borrower stops paying? The bank must have procedures like reminders or restructuring, your legal action, your collateral seizure. Important idea here is important thing in the slide is that the policies must be flexible. Why? Because economic conditions change during your recessions. Uh, Bank tighten your lending standards during your growth. Bank expand your lending. Rigid rules can destroy your banks, right? The risk manager must report to the board. Very important governance principle. Risk manager must have direct access to the board. If they report to the business head, profit pressure may hide your risk. This is a huge lesson from the 2008 crisis. Lending standards. Regulator requires banks to define your risk identification, your credit philosophy, your credit limits, right? And then we have the policy categories. Uh, the slide kind of conveys that lending policies fall into your three categories. One is your reduce or limit your credit risk. Example can be exposure limits, your diversification collateral. This connects to your credit portfolio management. Then classifying your asset. Loan must be classified based on quality. Example could be performing, your stress, your default. This links to your credit migration model. Establishing your loan loss provision. Banks must set aside reserves for your expected losses, right? For example, if expected default is 10 crore, bank provisions are 10 crore. This links to your expected loss is equal to PD into LGD into EAD. IFRS 9 provisioning, Basel capital, very important FRM concept, right, which we need to understand. Okay. Then we have the practice question, right? Within their credit risk management plan, banks are either required to include or at least should strongly consider including a what? A, the classification of risk organized by your collectability. B, loan loss provision equal to at least 8% of the loan portfolio. C, duration target for the bank portfolio that is not higher than 10. D is the rigid set of policy designed to address every possible risk source, right? So when we look at option A, right, classification of risk organized by collectability, right? So the meaning here is that loans are classified by ability to collect payments, right? Example could be your performing loans, your doubtful loans, your bad loan. This is your asset classification, which is kind of correct, right? So this is correct. We will keep it, right? Then we talk about the loan loss provisions equal to at least 8% of the loan portfolio. This is wrong, right? Why? Because regulators do not set the fixed percentages. Provisioning depend on your loan quality, your risk exposure, expected losses. So this goes away. Then option C is duration target less than equal to 10. Duration is related to interest rate risk, not your credit risk. So kind of incorrect, right? And when you look at option D, rigid policies, right? Rigid set of policy designed to address every possible risk source, clearly wrong. Uh, Lending policy must be kind of flexible. Rigid policy can destroy your banks, right? So with that, we understand the answer is A, right? Keep that in mind, right? I have eliminated all other options, so that should make sense, right? So that is what we have here, guys. Correct answer is A because banks must classify your asset based on collectability. This helps banks identify your stress loans, your potential defaults, your non-performing loans, etc. And why this matters in real banking, asset classification help your bank identify your problem loans early, calculate your provisions, allocate your capital, manage your portfolio risk. Without your classification, banks would hide your bad loans. And this happened in many crises, right? Now, when you connect this topic to the rest of the FRM part two, right, this topic links directly to your several key areas such as expected loss model, your where the provisioning comes from, your expected loss is equal to PD into LGD into EAD. That's the core FRM formula you've studied in FRM part one also, right? Then Basel capital also. Banks must hold capital against your credit risk, capital depends on probability of default, loss given default, exposure default, and credit portfolio model also. Example is your credit metrics model, your KMB model, your credit risk plus model, right? So credit metrics and KMB you've seen in FRM part one also. These models use asset classification and default probability. Then this is used for stress testing also, right? Banks stress test their loan portfolio using your recessions, your housing crash, your corporate default, right? From the real world perspective, what you need to keep in mind is that this topic is extremely important in banking. Example, when the India's NPA crisis 2015 to 19 happened, because there was weak lending policies, poor monitoring, excessive exposure to infrastructure, bad loans kind of crossed 10 lakh crore, right? So for you guys who are appearing for FRM Part 2 exam, remember these points. Credit risk is the larger risk of banks, right? That's the one case you have to remember. Lending policy define how loans are originated, monitor and recover. Policies must be flexible and adaptable. Loan must be classified based on your collectability, and provisioning must reflect your expected credit loans, right? So that is what we need to understand. Once we have this understanding, now we can go ahead and talk about other things. Okay. Then we are going now to talk about your setting of your exposure and concentration limits, right? See, when I talk about setting of exposure and concentration limits, this is one of the most important concepts in banks risk management. The bank doesn't fail because of one bad loan. Banks usually fail because of too much exposure to the same borrower or the same sector. And that happened in your 2008 crisis. Many banks had huge exposure to US housing market. When housing kind of collapsed, bank collapsed. This is called your concentration risk, right? Which is we need to understand. Okay. Now, when I talk about concentration limits, please understand concentration limit means a bank limits how much money it can lend to a single borrower, sector, or region. Why? Because putting too many eggs in one basket is dangerous. For example, suppose a bank has a capital of, let's say, $1 billion. If the bank now lends 550 million or 500 million to one company, that is extremely risky, right? If that company defaults, the bank collapses, so regulatory imposed limits. Typical limits are 10% to 25% of bank capital. For example, if capital is equal to $1 billion, maximum exposure is equal to 100 million to $250 million per borrower. That is what we need to keep in mind. Then we have the measurement challenges. Exposure measurement, not always simple, because credit exposure is not only loans. Banks also provide your guarantees, your letter of credit, your credit lines, your contingent liabilities. These are called your off balance sheet exposure. For example, if a bank guarantees a company's payment, the bank may still face your credit risk. So exposure calculation must include them, right? The important idea which you need to take away here is that because exposure is measured before recovery, collateral reduces your loss, not your exposure. This connects to your FRM formula also, where you say expected loss is equal to PD into LGD into EAD, right? Where EAD is exposure default, right? So collateral affects your loss given default, not your EAD, right? That is very, very important to understand. Okay. Then we have something called single client aggregation. This is again extremely important. A bank must treat your connected borrower as one client. So, for example, we have company A, company B, company C. If they belong to the same corporate group, they are treated as one borrower. Why? Because the parent company collapses, all subsidiaries collapse. This prevents your hidden concentration risk. Example is your Reliance Group, your Adani Group. Banks aggregate your exposure across your group companies that we need to understand. Then we have something called your risk management concern. Large exposure to one borrower creates two problems. Problem one is about your bank survival risk. If borrower kind of default, there is huge losses. Problem two is about your psychological bias. Bank officers become too attached to your large clients. Large corporate client contributes huge revenue, so bank may hesitate to downgrade your risk. This happened in many banking crises in the past. Therefore, risk manager must continuously monitor your large exposure, even if payments are currently on time, right? Then there is related parties. Related parties, these include your parent company, your subsidiaries, your major shareholders, your director, executive, affiliated companies. These people may influence the bank. For example, a director may push the bank to lend to his own company. This creates a conflict of interest, right? There are your internal limits to prevent your corruption or favoritism. Regulatory impose limits on related party lending, usually based on your tier 1 capital. For example, related party lending may be limited to 5% to 10% of tier 1 capital. regulation does not specify the limits. Banks must set your internal limits. This connects to your risk governance and your Basel regulation that we need to understand. Okay. All right. Once we understand that, right, then we have practice question number 2. So we analyze on this particular thing. Again, a risk analyst is reviewing his bank's credit risk management policy. He notes that the banks have limits on the related party financing decision. His colleagues agrees and correctly adds that option A, the term single client only refers to a legal person. Incorrect, right? This is not correct, because a single client includes your connected entities also, example, parent company and subsidiary. Second point is all banks have a limit of 10% of capital of single client. Again, incorrect, right? Limits vary across jurisdiction. Typical range is 10 to 25%. Third option, option C, loan collateral should be included in exposure sizing using your mark-to-market principle. Again, it is incorrect, because collateral reduces your loss, not your exposure. Exposure is measured before collateral, right? Then option D, which is acceptance, a letter of credit should be included in your exposure. Correct, right? This is correct. So answer is D, because they create your credit exposure, even though they may not appear as your loans, but we need to acceptance and letter of credit should be factored into the risk exposure of a single client. Okay. So answer is D, right? So that is what has been given here also, because your credit exposures includes your loans, your guarantees, your lines of credit, your letters of credit, your acceptances. All of these expose the bank to your counterparty risk. However, collateral is not included in your exposure measurement. Collateral affects your loss recovery, not your exposure size. Again, linking to your expected loss formula. All right. And that is what we need to understand. Okay. Now we go to your next part, which is your lending policy and credit risk reduction. Now we move to how your banks reduce your credit risk through your lending policy. This particular slide explains how lending should be structured. You look at the scope of your lending policies. The lending policy must cover the entire loan life cycle. From beginning to end, you have loan origination, credit appraisal, monitoring, collection, and this ensures risk is controlled throughout the loan's life, right? Then we have the lending authority. Not every employee can approve your loans. Banks set your approval limits. You look at your, what you say, junior officer approve loans up to $1 million. Senior officer approves loan up to $10 million. Credit committee approve larger loans. This prevents your reckless lending, inexperienced decision, etc. You have centralized versus your decentralized lending. Small banks have centralized approval, large bank decentralized by your geography, your product, your client segment. For example, you have corporate lending team, you have retail lending team, you have project finance team. You have types and distribution of loans. Banks must diversify your loan types. Example category are your commercial loans, your real estate loans, your consumer loans. Why? Because if all loans are in real estate, a housing crash can destroy the bank. This is your portfolio diversification. This connects to, again, your FRM topic, credit portfolio risk models. Then we need to look at your appraisal process. This is your credit analysis. Banks must define your appraisal standard, your risk assessment rules, your reappraisal requirements. For example, if you borrow renew loans, bank must revalue your credit risk. And then we have your things like your loan to value. Also, example is that house value is equal to $1 million. Loan is like 700K. LTV is 70%. Higher LTV is higher credit risk. This is extremely important in your mortgage lending. Then we have your loan pricing. Loan interest rate must reflect your risk. Loan interest or loan rate must include your cost of funds, your administrative cost, your expected credit losses, your profit margin. This connects to your FRM concept of RAROC, risk adjusted return on capital, right? Banks price loans based on your risk adjusted return, right? Then we have your maturities of loan maturity. Bank must define your maximum loan maturity. For example, working capital loan has short maturity, infrastructure loan has long maturity, but maturity must match your repayment ability, your asset life. For example, you cannot finance a 5-year project with a 1-year loan, right? So that is what we are talking about here, right? Now, this topic is continued ahead as well, right? So we are still looking at the lending policies and your credit risk reduction. So we're now getting deeper into risk reduction policies. We're looking at the geographic and sector concentration. Banks must monitor your exposure to your industries, your regions, your countries. For example, too much lending to your real estate, your energy sector, your emerging market. This is called your sector concentration risk. This connects to your FRM topic, your credit portfolio diversification. Then you have financial information requirements. Banks must demand your borrower information, financial statements, credit reports, or audit reports. Why? To estimate your probability of default. This connects directly to your credit risk modeling, right? Which we need to understand, right? Then we look at your monitoring and collection. Credit risk management doesn't stop after your loan approval. Bank must continuously monitor your financial performance, your payment behavior, your industry condition. If borrower kind of deteriorates, bank may restructure a loan, demand your collateral, and reduce your exposure. Then we have your limit on your total loans. Bank must limit total lending related to capital. Total loans cannot exceed your certain multiples of capital or deposit. This protects your bank solvency. Then we look at your loan to value and margin requirements. Bank require your collateral margin. Example, collateral value is equal to $100. Loan given is like 70. Margin is equal to 30. If collateral price kind of falls, bank may request your additional margin. This is common in your securities lending, right? Then we look at your impairment recognition and restructured debt. Bank must identify your loan impairment early. Impairment means borrowers may not fully repay. The example signals are your missed payments, your declining business, your restructuring requests, repeated restructuring signals, your high credit risk. This connects to your IFRS 9 expected credit loss model, your loan loss provisioning. And then we should have a documented policies. All policies must be written and documented, not informal. Why? Because documentation ensures your accountability, your regulatory compliance, your consistent decision making. And when you connect these topics to other FRM areas, please understand this chapter or this module or this topic connects strongly to your credit risk models, your Merton model, which will come ahead, your credit metrics model, your credit risk plus model, the Basel regulation also. Bank must hold capital for your credit risk, your concentration risk, expected loss model also. EL is equal to PD into LGD into EAD. Loan policies affect all three variables. Then we look at the real world importance. Poor concentration management causes major crisis. Example is 2008 crisis where you had the housing concentration, European crisis, your sovereign debt exposure, Indian PSU bank, your infrastructure exposure. That is why concentration limits are kind of critical. The key FRM exam takeaway here is that remember these banks limit exposure to single borrower. Exposure includes your off-balance sheet items. Collateral is not counted in exposure management or measurement. Connected borrower must be aggregated. Lending policies define how risk is kind of controlled, right? So that is what we need to keep in mind. All right. Then we go to the practice question here that we need to understand. Again, a regional bank wants to decrease risk in their lending practices. They are considering several lending policy changes. Which are the following items, right, should be included in this new risk reduction focus direction, right? So basically, we're talking about which policy should we adopt, right? So when you look at your question, right, the key phrase here is that risk reduction focus lending policy, right? So we are looking for a policy that reduces your credit risk. So let's analyze each option. Option A, all loans should have a maximum maturity schedule of 10 years. Incorrect, right? We see different loans require different maturities. Working capital loans are short term, infrastructure loans are 15 to 20 years. So fixed maturity for all loans is kind of unrealistic. Then we have option B, which is the board should approve all individual delinquency workout plan. Right. Again, it is incorrect. Why? Because the board sets a policy, not operational decision. If the board approved every case, decision making would be too slow. Operation would stop. Instead, bank creates a delinquency policy, right? Then option C, financial projections from business clients should match the maturity of the loan. Again, this is correct. Why? Because repayment ability must cover the entire loan period. For example, if a company takes a 5-year loan, right? The bank must analyze the 5-year revenue projection, the 5-year cash flow. This ensures borrowers can repay throughout the loan life, right? Option D, credit officer should have the flexibility to extend any type of credit that the customer needs as long as they find it to be reasonable risk for the bank. Not correct, because this creates your moral hazard. Banks must follow defined lending policies, not unlimited discretion. So correct answer here is C. Right, matching your financial projection with your loan maturity reduces your reduces your risk, right? Because repayment ability is validated, long-term risk is evaluated, credit analysis become realistic. If you connect this to FRM, other topics, this concept link directly to credit analysis, your cash flow projection used to estimate your probability of default, your credit modeling, financial projection feed into your structure models, your credit scoring models, etc. Right, which we need to understand. All right. Okay, fine. Then we go to next topic, which is the review of the loan portfolio. We move to your portfolio monitoring. Again, remember something very important. Banks do not fail because of one bad loan. They fail because many loans deteriorate simultaneously. Therefore, banks must continuously review the loan portfolio. Why portfolio review is important? Because loan portfolio must reflect your market demand, your bank strategy, your risk tolerance. For example, a conservative bank may prefer your retail mortgages, your diversified portfolios. An aggressive bank may lend heavily to your corporate projects, your infrastructure. So portfolio review ensures risk premium remain under your control, right? And then we need to have your portfolio review coverage. So this particular slide says portfolio reviews must cover large portion of the portfolio. 75% of your total loan value, meaning most of the loan amount must be reviewed. Why? Because large loans dominate your risk exposure. For example, if let's say 10 corporate loan represent 80% of exposure, they must be reviewed carefully. 30% of the number of loans, even if loans are small, some must be sampled. Why? Because retail portfolios may have thousands of small loans. Sampling helps you detect your problems. 50% of foreign loans have additional risk of political risk, exchange rate risk, legal risk. Therefore, more scrutiny is required. Loans with maturities greater than 1 year, long-term loans have higher uncertainty. Banks must look at, for example, business conditions may change, therefore they require regular monitoring. Additional loan portfolio reviews. Certain loan must always be reviewed. Large borrower loans where exposure exceeds 5% of bank capital. Why? Because large borrowers create a concentration risk. If they default, banks may suffer huge losses. The related parties, loans to your director, shareholder, affiliated companies, they create conflict of interest. They require special monitoring. The modified loans whose terms have been shared or whose terms have been altered. Example, your uh, extended maturity, your lower interest rate, such changes may signal your borrower distress. The loans overdue more than 30 days, these loans are your early signal or early warning signals even before becoming your non-performing loans. Banks monitor them carefully. Loans already classified as risky, uh, loans categorized as your substandard or doubtful or low on loss. Those must be monitored constantly, right? Now, once we have looked at the review of the loan portfolio, right, then we also, you know, each individual loan review, right? So when a bank reviews a loan, it must collect your detailed information, your customer information. Bank reviews your business model, your industry, your management quality, because your borrower strength determines your default risk. Loan term, bank checks your interest rate, your maturity, your repayment schedule. This ensures loan structure still makes sense. Then use of fund, banks must verify that loan money is used for the intended purpose. For example, loan for factory expansion should not be used for your stock speculation, your collateral structure. Bank reviews your collateral value, legal documentation, enforceability. This affects your loss given default, borrower, financial condition. Bank reviews your balance sheet, your income statement, your cash flow. This determines your repayment capacity. Then we have the monitoring efforts, bank track, your site visits, your financial reporting, your covenant compliance. This is called your credit monitoring. Then we look at your large loan monitoring, right? Large loan monitoring. If loan exposure exceeds 5% of bank capital, the bank must analyze borrower business plan, ability to service your debt. This is essentially a deep credit analysis. And then there is a role of credit officer. Loan review includes input from the credit officer responsible for the loan. Why? Because they understand borrower behavior, your operational detail, but independent risk team also review the loan to avoid your bias, right? That we need to understand. Okay. Then when we go to the next part, which is your review of the bank's policies, right? Topic number 5. Now we are moving from your loan review to policy review. This is an important governance aspect, governance concept. Even lending policy must be reviewed periodically. Why? Because economic condition kind of change. For example, interest rate change, industries decline, new risks appear, so policies must evolve. And what the policy review includes is one is the survey of the your existing policy. Risk managers examine how current policies work, whether they are kind of effective. For example, are lending right limits too close? Asset classification process. This they check whether loans are properly categorized as standard, your substandard, your doubtful, your loss. Misclassification hides your credit risk. Then assessment of your current risk factor. Risk managers analyze your current economic risk. Example, your housing bubble, your recession risk, your sector risk. Focus must be on your current condition, not on your past trends. Then we have the historical loss analysis. Banks analyze your past default rates, your recovery rates. This helps estimate your expected loss. Again, you link it to FRM formula of ED is equal to PD, EL is equal to PD into LGD into EAD. And you look at your adequacy of current policies. Risk managers ask, is our policy strong enough? If not, they revise it. So additional risk to review. Banks must also examine your interbank deposit, your off-balance sheet exposure. Example are guarantees, your letter of credit, your derivative exposure. These can create your hidden credit risk, which we need to understand, right? Okay. Once we have seen that, we go to the next topic, which is your credit asset classification, right? So we reach a very important topic for your FRM exam. This is how your bank categorize loans based on credit quality. What is your asset classification? Asset classification means assigning loans to your risk categories based on your probability of repayment. Banks do this when the loan is issued during periodic reviews, right? Again, factors considers banks evaluate borrower financial health, payment performance, your economic condition. If risk increases, loan is kind of downgraded. Regulator use your 5 categories for asset classification. These are widely used globally. One is your standard, which is pass. These loans are healthy. Characteristics generally are borrowers paying regularly, no delinquency risk. These loans require normal monitoring. Then special mention, which is a watch list, early warning stage, loans show potential weakness. Example is declining profit, industry slowdown, but borrower is still paying, banks monitor closely. Then we have substandard. Now risk becomes kind of serious. Problems appear, such as your borrower cash flow stress, your repayment difficulty. Often loan is overdue greater than 90 days. Primary repayment source is weak. Banks may rely on collateral. Then we have doubtful. This is worse than your standard. Repayment is highly uncertain. Example is severe financial distress, restructuring attempt, loan overdue greater than 180 days, often fall here. Expected loss becomes high. Loss, the worst category, loan is almost unrecoverable. Example is borrower bankrupt, collateral insufficient, loan overdue greater than 1 year, often classified as loss. These loans are usually written off. Why your asset classification is important? Because it determines your loan loss provisions, your bank capital requirements, your financial reporting. This links directly to your Basel regulations. Bank must hold your capital against your risky assets. If you look at your connections to your other FRM topic, please understand that this particular section connects to your expected credit loss, which is ECL, IFRS 9 provisioning, credit migration model, tracking your rating transactions, credit portfolio loss or credit portfolio risk. Risk depends on distribution of loan quality. Look at the real world example. India's NPA crisis happened because your banks delayed recognizing your bad loans. Loans stayed classified as standard, even when borrowers were kind of stressed. So one asset classification kind of tightened. NPA surged dramatically. Key FRM exam takeaway is, but must understand, portfolio review prevents your hidden risk accumulation. Large loans and party loans need special monitoring. Lending policies must be periodically reviewed, and your asset classification categories loan by your credit quality, right? 5 categories exist here. One is standard, right? One is special mention watch, one is your substandard, one is your doubtful, one is your loss, right? That is what we need to understand clearly. Okay, once we have done this, we have practice question 3.5 months ago. XYZ Manufacturing lost their single largest customer and the company stopped service of all debt payments to ABC Bank. The bank has seized some collateral, but they're working with XYZ. They form plans to find new customers and build a better future. For now, the loans to XYZ Manufacturing should most likely be classified as what? Right. So again, let's try to understand this. A company XYZ Manufacturing lost its largest customer. It kind of stopped paying loan installments, payments overdue for 3.5 months, so almost like 105 days. Bank has already started assessing your collateral, accessing your collateral, but the bank still believe recovery is possible, right? What should the loan be classified, right? See, when you convert time into delinquency category, right? So 3.5 months, which I said 105 days overdue. Now, if you recall the asset classification threshold, right? Special mention was early warning less than 90 days. Substandard was greater than 90 days, right? Doubtful was greater than 180 days and loss was greater than 1 year, right? So 105 days are greater than 90 days. So loan is already your non-performing, right? Now we have to understand the severity, assess the severity. So important clues which are given in the question are bank started assessing your collateral, borrower lost main customer, payments kind of stop, but recovery is still possible. So risk is serious, but not your hopeless scenario, right? So now we have to eliminate the wrong option, right? When you look at option D, right, start from the bottom, right, specially mentioned, that is wrong, right? Why specially mentioned is wrong? Because this category applies when your problems are emerging, borrower still mostly paying, but here payments have already stopped for 105 days, so this is beyond watch list, right? Then option B, if you look at doubtful, that is also wrong, right? Doubtful loans usually involve greater than your 180 days delinquency, very high probability of loss, but here borrower still has a recovery path. Option A, loss, is also wrong here because loan classification means, or loss classification means that repayment almost impossible. Loan should be written off, but the bank still sees future recovery potential. So correct answer is substandard, right? So because loan overdue greater than 90 days, primary repayment source kind of failed, bank relying on collateral, but your borrower may still recover, right? So if you want a real life example, think about your Indian infrastructure companies during the 2015 NPA crisis. Many firms lost your revenue contracts, delayed your loan payments, but still had projects and assets. Banks classified them as your substandard asset before they deteriorated into a doubtful. That we need to understand. Okay. Then okay, fine. I think this is what is the answer. XYZ Manufacturing is approximating 105 delinquent on your debt service payments. ABC Bank has begun to assess secondary source of capital. But XYZ has hope for repayment. There is a path for them to move forward. A renegotiation may be needed down the line, but for now, this loan should be classified as substandard. They are not as severe as doubtful or loss, but they are bigger concern than merely being classified as specially mentioned, right? All right. Once we have understood this, we get into the next topic, right? Next topic is your non-performing loans. Now, in the non-performing category, we move to one of the most important topics in credit risk. This topic explains how your banks handle your bad loans. What is exactly a non-performing loan? A loan becoming non-performing is when the borrower stops paying your interest or principal. Most regulations define a non-performing loan as payments overdue more than 90 days. At this stage, loan stops generating income, credit risk rises significantly. Why your NLPs, right, non-performing loans are dangerous for bank? Because NPLs, right, non-performing loans create multiple problems. Your loss of income, interest income kind of disappears. Capital pressure, bank must set aside your provisions. Liquidity stress, money lent cannot be reused. Reputation damage, markets start questioning bank stability. And if you're doing the NPL analysis, key considerations, banks analyze your NPL carefully rather than treating them all the same. Age of delinquency is analyzed. Age means how long the loan has been unpaid. For example, 30 days, 90 days, 180 days, 1 year. The longer the delay, the lower the recovery profitability or probability. Then we have reasons for delinquency. Banks try to understand the root cause. Your example causes are temporary liquidity problem, loss of key customer, industry downturn, your fraud. This matter because some problems are kind of temporary, right? Then we look at your, example also in that category, airline industry during COVID, many industries or many airline defaulted temporarily but later recovered. Case by case assessment, banks cannot treat all non-performing loans equally. Each borrower has different business model, your collateral, your recovery potential. So banks review your loans individually. Then we set the provision levels. Banks must decide how much money to reserve for your potential loss. Higher risk loans require higher provision. This protects the bank's kind of balance sheet, right? So with this, we have understood non-performing loans, and we have also completed your module 1, right? Now we get into your module 2, right? Module 2, when we talk about, is about loan loss provisioning and your credit risk assessment, right? This module shifts from identifying your bad loans to quantifying your losses. And the topics are 7, loan loss provisions and reserves, expected loss versus expected loss under IFRS 9, managing a loss asset, credit risk analysis, credit risk management capacity, and key question for board of directors, right? This module connects strongly with your Basel capital rules, credit risk modeling, and bank regulation that we need to understand, right? Okay, let's start to dig deeper now. So the first thing here is about your loan loss provision and reserves. So now we are discussing how your banks prepare for your future credit losses. When you talk about your loan loss provisions are basically funds a bank set aside to cover your expected future loan losses. Think of it like your insurance is at the bank balance sheet. For example, bank lends your 100 crore to companies based on a risk model. It expects 5 crore losses, so bank records provision for 5 crore. Then we have your loan loss reserve. Reserves are simply the accumulated provisions over time. So provisions yearly change. Reserve is the total pool of provision. Where do your reserves appear? They appear on the balance sheet. They reduce the value of the loan asset. For example, loans are 100 crore, reserve are 5 crore. So net loan value is 95 crore. There is a regulatory capital treatment. Loan loss reserves are usually counted as your tier 2 capital by because they provide a buffer against your credit losses, but regulators limit how much can you count towards your capital, right? Then we have the factors for determining your reserves, determining reserve levels. Bank considers several factors when deciding your reserves. You have credit policies. If lending standards are weak, reserve requirement kind of increases. Example is aggressive lending leads to higher future default. Then we have your historical loss experience. Past losses help you estimate your future losses. This is the basis of many credit risk models, right? Then you have the growth of loan portfolio. If loan book, right, grows rapidly, this kind of increases, more reserves may be required. Then we have the quality of lending management. If the credit team is experienced, loan quality improves. Low reserves may be needed. Then we look at the recovery and collection system. Strong recovery teams can restructure a loan, collect your collateral. This reduces your expected losses. Then we have your economic environment. Basically, macroeconomic conditions matter. Example is during recession, unemployment rises, business profit falls, default increases. So bank increase your provision. So that is what we need to keep in mind. And then once we have seen that, we go to the practice question. In this practice question, uh, two senior credit managers are reviewing the bank's loan loss reserve procedures. Which of the following elements is most important? Which of the following element is most important when determining the appropriate level of reserves? So we have 4 options: current loss reserves, the bank's experience with the previous losses, the current number of non-performing loans in aggregate, a list of all loans that are delinquent for more than 180 days, right? First, understand the logic, right? In this question, provisioning must estimate your future losses. We all agree with that, right? The best predictor of your future losses is often your historical loss experience, right? Now we try to eliminate the wrong answers. So option A is your current reserves, right? Which is your wrong option because existing reserves do not determine your future needs. Then you look at your, what do you say, option B, which is your bank's experience with the previous losses. This is correct, right? This is correct, right? Well, the reason is that historical data helps you estimate your default probability, your recovery rate, your expected credit losses. This forms the foundation of your modern credit risk modeling, right? And then we look at your option C, which is the the current number of non-performing loans in aggregate, right? This is again wrong. Reason is this is only one indicator. Provisioning must consider your long-term pattern as well. Then option D, loans overdue greater than 180 days. This is again wrong, right? This focuses only on one stage of delinquency. Provisioning must consider the whole portfolio. So the correct answer is option B. Banks experience with previous losses because historical data helps you estimate your default probability, your recovery rate, your expected credit losses. This forms the foundation of your modern credit risk modeling, right? Overall, if you want to understand from the FRM perspective, the concept directly linked to your expected loss formula, where we understand that expected loss is PD into LGD into EAD, probability of default into exposure of default into loss given default, right? Okay. Once we have understood this, this is the answer. It is important to include the bank's previous experience with loan losses. Loss provision should not be biased by the number of aggregate losses already in the books. Loss provisioning needs to consider the bank's policies at a high level and not focus on classification issues, the number of days delinquent. If they did factor delinquency, then 180 days is too long. Okay. Then we go into your expected loss versus unexpected loss. Now, this is one of the most fundamental concept in credit risk, especially the credit risk modeling part, and appears frequently in your exam also, FRM exam, the Basel capital frameworks, and bank risk management system. You should think of it this way, that banks know that some loans will default, but they must distinguish between the normal predictable losses and the extreme rare losses. This is exactly the difference between your expected loss and your unexpected loss. So when we talk about your expected loss is the average loss a bank expects over time from its lending portfolio. It is a statistical expectation based on your historical data. Banks price this loss into your loan interest rate, your provisioning, your credit spread, right? And if you look at simply, right, suppose there are 100 simple borrowers who take loans, historically two borrower default, bank losses 50,000 per default, expected loss we calculate, right? The bank expects this every year, right? So it must price or provision for the expected loss every year. What are the components of expected loss? Expected loss has three components. This formula is very, very important to understand. Your PD into LGD into EAD. PD is the probability of default. PD measures the likelihood that borrower fails to repay the loan. PD estimation uses your historical default data, your credit ratings, your credit scoring models, your CDS spread, your macroeconomic indicators, right? So corporate borrower rates, your triple B historical default probability, 2% over 1 year, etc. Right? Loss given default, LGD measures your percentage of money the bank loses if default happens. You know, in FRM part 1 also you studied this. It depends heavily on your collateral, your loan seniority, your recovery process, your legal system. Let's say the loan amount is 1 crore, collateral received is 60 lakhs, loss is equal to, or collateral recovered is 60 lakh, loss equal to 40 lakh. The important idea here is, right, that LGD depends on your loan product structure. If loan type is secured mortgage, typical LGD is low. If loan type is senior corporate loan, typically LGD is medium. If loan type is unsecured credit card, it is typical LGD is higher. So that is why when you look at the slide, LGD considered the product used for credit risk, right? Now we look at your unexpected or EAD also, right? Exposure at default. EAD measures the amount outstanding at the moment of default. For many loans, this is simply the loan balance, but for credit loan, it is most complicated. Credit card limit is, let's say, 5 lakh. Borrower has used 2 lakh. At default, the borrower may draw more, so the bank estimate the future exposure as well, which will come in your subsequent topic as well, right? So if you want to calculate the expected loss example, let's calculate a kind of a real example. Loan amount is 10 lakh, PD is equal to 5, LGD is equal to 40%, EAD is equal to 10 lakh. So you multiply it. So the bank expected an average loss of 5% into 40% into 10 lakh, right? Which is 20,000, right? Then we go to unexpected loss, right? Unexpected loss is different, right? It represents your loss beyond the expected level. These losses occur during your extreme event. Example is financial crisis, your economic collapse, your industry-wide default. For example, expected loss might be 20,000, but in recession, 10 borrowers default instead of 2. So the actual loss is like 1 lakh, right? So what happens is that you calculate the unexpected loss in this case, right? So that is what you have to remember, right? So again, it is considered a tail risk event such as a 99th percentile event. You see here, AAA, the loan amount is given, PD, LGD, EAD, expected loss is given, right? B also the same thing, defaulted also the same thing, right? So why your unexpected loss kind of matters, right? Please understand, unexpected loss determine your economic capital, your Basel regulatory capital. Bank must hold your capital to absorb those tail risks, right? Which is very, very important, right? Uh, how the banks cover the losses, expected loss, they try to cover by your loan pricing plus provision, unexpected loss by capital buffer. So that is what we need to understand. Everything, all these things which I have said now, right? You have studied all these things in FRM part one also, right? So it's just a quick revision. Now, which are the following components of expected loss considers the project that was used for the loan? Which are the following components of expected loss? Consider the product that was used for the loan, right? So unexpected, loss given default, exposure default, probability of default, right? So basically, we are talking about a loan structure, right? See, which factor depends on loan structure, right? For example, mortgage or unsecured loan or subordinate debt, right? So the answer is probability of default, right? So not probability of default, but if you look at probability of default, right, it is wrong, right? Why probability of default is wrong? Because probability of default depends mainly on borrower credit quality, not on your loan product, so it's wrong. Option C, exposure at default. This is also wrong, right? Because exposure default measures your loan amount of default, depends on loan utilization, not your product type. If you look at your unexpected losses, option A, that is also wrong because unexpected loss is not part of your expected loss component, so wrong. Correct answer is B. Correct answer is B. Why B? Because when you look at your loan or loss given default, LGD depends on your collaterals, LGD depends on your seniority, LGD depends on your recovery structure. These depend on the loan product type. That is what we need to understand, right? So correct answer is B. Okay. This is what is given here also, the component of expected loss that considers which loan product was used is the loss given default. The probability of default, PD, consider which client is associated with the loan, while the exposure default, EAD, consider how long the loan has been outstanding, right? So that is one part. Then we get into your expected loss under IFRS 9, right? So now we move to a very important regulatory concept, right? In 2018, accounting standards changed dramatically. Old system had IAS 39, which has incurred loss model. Banks recognize losses only after default occurred. This caused huge problem during the 2008 financial crisis. So regulator introduced something called IFRS 9 expected credit loss model. The key idea of IFRS 9 was that banks must recognize your expected future losses earlier, even before your default kind of occur. This is called your forward-looking provisioning. So IFRS 9 is basically a three-stage model, right? When you look at IFRS 9, right? So IFRS 9, there are three: stage one, stage two, stage three. So loan move through your, but you say, uh, three stages of credit deterioration. Stage one is about your performing loans, loans that are current, loans that are not delinquent, loans are normal credit risk. Provision require your 12-month expected loss, meaning expected losses within the next year. Interest is calculated on the gross loan amount. For example, mortgage borrower paying normally bank only provisions for 12 months of default probability, right? And stage two is about your credit deterioration, loans showing significant increase in credit risk. Example is payment delays, declining borrower credit quality, macroeconomic stress. Provision require your lifetime, your expected loss, meaning your expected loss over the entire loan life. So interest still calculated on the gross amount. Stage three is about your non-performing loans. These are your non-performing loans. Borrower is seriously delinquent, unlikely to pay. Provision required is lifetime expected loss. But interest is calculated on the net carrying amount, meaning loan value minus your provision, right? Why this matter? IFRS 9 forces banks to recognize your losses earlier, unlike your 2008 financial crisis, improve your credit monitoring, increase your transparency. That is why many banks saw huge provisions in your 2020 during your COVID as well. Okay, so remember that. Now we move into your next part, right? Which is your practice question number 3. Loan A or bank's loan asset is considered delinquent but not yet non-performing. This is there is a short-term macroeconomic event that is temporarily preventing repayment according to IFRS 9. Which stage is required for this specific loan? So there are 4 stages. We know that stage 1, 2, 3, 4, right? First stage 1 is identify your loan status. Loan is delinquent, not yet NPL, right? So stage 1 is generally we consider performing. Right, stage 2 is delinquent and your risk increase. Stage 3 is non-performing. Then we apply the logic. Since the loan is delinquent but not your non-performing, it fits your stage 2. Right, so correct answer is stage 2. Stage 2 loans require lifetime expected loss provisioning, right? So that is what we need to remember. Okay, straightforward, right? If you remember it can be solved easily, right? So IFRS 9 requires 3 stages of reporting. Stage 1 is for performing asset. They can apply a 12-month expected loss methodology using your effective interest imputed. Stage 2 is for asset with some level of delinquency. They can apply a lifetime expected loss methodology using your effective interest compound. Stage 3 is about your non-performing asset. They can apply a lifetime expected loss methodology using effective interest computed based on the net amount. Right? That is what we have, right? Then the key FRM takeaway here is that expected loss formula we have to understand. We have to understand expected loss is normal loss. Unexpected loss is your tail risk. IFRS 9 introduces your forward-looking provision. IFRS 9 has stages. Stage 1 is performing. Stage 2 is deteriorating. Stage 3 is non-performing. Right. And then we go into the next topic, which is your managing of your loss asset. Right. When a borrower cannot repay the loan becomes a loan asset or the distressed asset, right? So banks then enter a process called your loan workout, right? So objective is simple: recover as much money as possible and minimize the loss. This is handled by your special asset management teams or recovery teams inside banks. Then there is a loan workout procedure. About the loan workout is the process banks follow when the borrower is in financial distress. Banks review your historical recovery process, historical recovery success, borrower financial condition, your collateral value, your restructuring options. And this slide, right, lists your 4 typical steps, right? Step 1 is you're reducing the credit exposure. Bank try to reduce its risk. Methods include asking for additional collateral, requesting your new guarantees, injecting your new equity capital. For example, a company defaults on a 100 crore loan. The banks may require promoters to pledge your additional shares, new collateral assets. This reduces your loss given default. Then step 2 is about work with the borrower. Instead of forcing a default immediately, banks may try to improve the borrower's ability to repay. Possible action is restructuring your loan repayment, advising your cost reduction, selling your non-core assets, extending your loan maturity. This is similar to your financial restructuring consulting. For example, airlines companies often negotiate your restructuring during crisis. Step 3 is you bring on a third party. Sometimes the borrower cannot recover a loan. Banks may introduce a strategic investor, private equity investor, joint venture partner. For example, a distressed manufacturing firm might sell 50% stake to a new investor. The new capital helps repay the bank loans. Step 4 is about liquidation, right? If recovery fails, the bank forces liquidation. Possible actions are foreclosure, selling collateral, enforcing guarantees. For example, mortgage borrower default, bank sells the property. This is the last option because recovery rates may be low, right? Then you look at the approaches to managing your loss asset. Banks historically follow 2 accounting approaches. One is you're retaining your loan assets or retaining your loss asset. That is the British model in this approach. The banks keeps the bad loan on the balance sheet. The reason is they believe the recovery may still happen later, right? So the loan remains in the books or remains on the books while recovery efforts kind of continue. What is the impact on the financial statements here is loan loss reserve appears larger because the loan remains on the system. The approach gives manager time to restructure, recover value, and renegotiate. Another approach is writing off your loss asset, which is a US model. In the US approach, banks immediately write down your bad loans, meaning the loan is removed from the balance sheet. Recovery may still happen later, but the bank assumes low probability. What is the impact on balance sheet? Loan loss reserves appear smaller related to the portfolio because the loan or bad loan is already written off, right? So the key difference is that in the first model, British model, the treatment is you retain the bad models or retain the bad loans. In the US model, you write off the bad loans, right? So that is what you do. Fine. Now we go into the practice question, right? A financial analyst for ABC Bank notices that loan loss reserves are fairly small relative to the size of the bank's loan portfolio. He tells his coworker that this is a red flag for him. However, his coworker tells him that there could be an easy explanation that a bank could be cleared up by asking management. The coworker is suggesting that ABC Bank should be following the what? So the overall idea here is that analyst notices loan loss reserves are very small relative to the loan portfolio. He thinks this is a red flag. Okay, but the coworker says it may simply be due to the bank's accounting approach. Which model explain this? See, first of all, understand the clue. Loan loss reserves appear small. Which models cause that? British model, right? Losses or loss asset are retained. This increases your revenue, so reserve appear larger, which is kind of not correct, right? So if you have US model, loss assets are written off immediately. This reduces your reserves, so reserves appear small, right? So correct answer US model. Now in US model, we have BCD option. Which one is it, right? So answer is B, right? US model and using the write-down model for addressing loss thing. Loss asset, US model providing internal consulting, wrong. Allowing more time for collection, wrong. British, wrong, right? So answer is B. US model using the write-down model because immediate write-off reduces your loan loss reserves on the balance sheet. Okay. All right. Now here we're going to this is what the answer is, right? The US model involves immediate write downs. This method allows for the option of repayment, but treat it is unlikely. It will make the loan loss reserve appear smaller on the balance sheet. The British model uses retention of loss asset, which will make the loan loss reserve appear much larger on the balance sheet than the write-off model. While loss assets are retained on the balance sheet, managers give more attention to loss workout options. Okay, so that is what we understand. Finally, we go into the next part, which is the credit risk analysis. So now we move from your individual loans to your portfolio level, your credit risk analysis. Banks do not only evaluate a single borrowers, bank analyze entire loan portfolios. The key components of your credit risk analysis is that there are three core dimensions here. Credit risk analysis must evaluate your lending products, your customer base, your loan terms. Lending products means bank analyze the risk of different loan products. Example can be your mortgages, your corporate loans, your SME loans, your credit card. Your each product has different risk characteristics. For example, if your mortgage, the risk level is low. If your corporate loan, the risk level is high. Credit card is very, very high. Corporate loan can be said medium also. You look at the customer base, bank must understand who the customers are. Borrowers may include your government, your corporations, your SMEs, your retail customer. Each category has different default probabilities. For example, government loans usually have very low probability of default. Then we have loan terms also. Loan structure affects your risk. Important factors are maturity, your interest rate, your collateral, your repayment structure. Example is that long-term loans carry more uncertainty, right? When you look at the key components of your portfolio credit risk analysis, the bank's risk report normally includes several sections. There is summary of your major loan types. Bank summarize your number of loans, your average maturity, your average interest rate. So you have mortgage, you have a number, you have average rate, you have average maturity, same for corporate also. Then we talk about the portfolio distribution also. Bank analyze the number of loans, the total lending, your sector exposure. For example, real estate might be 35, manufacturing might be 35, retail might be 20, something might be 25 as well. This helps identify your concentration risk. Then you have to understand the government guarantees. Some loans are guaranteed by government, development banks, export credit agencies. These guarantees reduce your default risk. Then risk classification. Bank categorize loan as your performing, your watch list, your substandard, your doubtful, your non-performing. This classification helps you track your credit deterioration. And then we look at your non-performing loan analysis. Banks analyze your non-performing loans by your vintage year. Vintage year means this year or the year when the loan was originated. For example, vintage year can be 2021, 2022, 23, anything. They would have different default rates. If recent loans default faster, underlying standards may be kind of weak, right? Once we have understood this, then we go ahead. Now we have a practice question. A portfolio level credit risk analysis should include what? Uh, Customer segmentation data, current macroeconomic condition, commentary from the credit risk officer, or details on the bank's interest rate hedging policy, right? So basically, the first step here is what does portfolio credit analysis examine? Basically, it focuses on the loan portfolio structure that includes your loan type, your borrower segment, your risk distribution, right? So when you talk about your customer segmentation data, so that's true, right? Uh, in the customer segmentation data, this includes your grouping borrowers into your retail, corporate, government, right? This is essential for your portfolio analysis. Option B, current macroeconomic conditions, right? Uh, Understand that these affect your credit risk, but are not part of your portfolio structure analysis. So we don't see that. Credit officer commentary. This is qualitative opinion, not your portfolio analysis. Details on the bank interest rate hedging policy. This relate to your market risk, not your credit risk. This also goes away. So answer here is A, right? So customer segmentation data, because when you look at your because portfolio credit analysis must evaluate borrower categories and risk distribution, right? So that's what we need to understand. The key idea here is managing your loss assets, loan workout attempts recovery, 4 steps, exposure, reduction, restructuring, third party, liquidation, accounting approaches, your British model and US model retain, British model retain the bad loans, US model write off immediately. Portfolio credit analysis, banks analyze your loan types, your borrower segment, your loan terms, your portfolio distribution, your non-performing loans, vintages that we need to understand. Okay. All right. Then we go into the next part, which is your credit risk management capacity. We, on this topic, right, answers an important question that the bank actually has the capability to manage your credit risk effectively. Even if a bank has good models, let's say for PD, LGD, EAD, poor processes, staff, or reporting system can still cause your massive credit losses, right? Therefore, regulators and auditors evaluate a bank's credit risk management capacity. We look at your role of the board of directors. The board of directors hold ultimate responsibility for credit risk oversight. Their objectives are to ensure that loans are sound and collective, profitable, aligned with the society's legitimate lending models. In other words, the bank should earn profit without taking excessive risk. Then the key components of your credit risk management review. Review of the bank's credit risk management capacity focuses on 3 major areas: your lending process, your staffing, your information flow. You try to break these down. Lending process, this examines how loans are created and monitored. The review covers the entire loan life cycle. The loan life cycle in banks have loan origination, credit appraisal, loan approval, monitoring, collection, or recovery. Loan origination, the stage involves identifying your borrowers, collecting your financial information, determining your loan purpose. Example is corporate borrower submits your financial statement and project plans. When you have credit appraisal, right, keep in mind you have as the bank evaluates your borrower creditworthiness, cash flow stability, collateral value. Typical analysis include your financial ratio, industry outlook, credit rating models. Then we have the loan approval. Bank maintain your lending limits at different management levels. Loan size is smaller, approval level is from different person. Loan size is higher, approval level is different person. This ensures risk control and accountability. Then you have monitoring and collection. Once the loan is issued, bank must monitor your repayment behavior, your financial performance of borrower, your collateral value. Monitoring also includes your tracking, delinquency rate, early warning signals. Then your application versus approval ratio. Bank or risk reviews also examine how many loan applications were approved versus rejected. If approvals are extremely high, underwriting standards may be too relaxed. Typical review period is 6 to 12 months. right? Then we look at your staffing. Credit risk management is not only about models, it depends heavily on your human expertise. The review examines your number of staff in credit risk, qualification and experience, responsibilities and reporting structure. Risk team usually include your credit analyst, risk managers, credit monitoring teams, recovery specialists. Banks also examine your staff, training your frequency and adequacy because outdated credit knowledge increase your risk. Then you look at your information flow. This is extremely important in risk management. Information must move quickly and accurately from operational team to senior leadership. The review checks whether lending information reaches your senior managers, the board of directors, the risk committee. And then you look at the example of poor information flow also, right? For example, loan default rate rises in the SME segment, but this information reaches your senior management 6 months later. By then, losses are already large. So timely information flow is very, very critical. Okay. Once we have seen this, we go ahead, we talk about your key questions for the board of directors, right? So when you talk about key question for the board of directors, see, once the bank side system is in place, the board must continuously challenge your management with critical questions. These questions ensure the bank risk taking is sustainable. The first part is we need to understand is are loans and deposits competitively priced? Banks must ensure the loan pricing reflects risk. Example is that if a bank offers low interest rate loan to risky borrowers, loans may exceed your income. So pricing must reflect your default rates, your funding costs, your capital costs, etc. Second is, are the sources of interest income diversified? Banks should avoid relying too quickly on one sector or product. So this is the example of a dangerous concentration. A bank whose loan portfolio is 70% real asset, if the property market kind of crashes, huge losses, diversification reduces your risk. Then we have the does portfolio return reflect your risk taken? Again, high returns often come with high risk. The board must check whether returns justify the risk level. For example, if your portfolio yields 10% return, but default risk is extremely high, the risk-adjusted return may actually be poor. Then the fourth part is, can the bank survive stress scenarios? Bank must perform your stress tests. Example of stress scenarios include your economic recession, property market collapse, your interest rate spike. So interest testing or stress testing checks whether the bank can survive extreme condition or not. Then internal rating models are reliable or not. Banks use internal models to estimate your PD, probability of default, LGD, loss given default, exposure default, EAD. The board must verify whether these models are historically accurate or not. If models underestimate your risk, capital may be insufficient. And then how often a stress test perform? Stress testing should be conducted regularly, typical frequency quarterly, annually. Stress testing help your bank prepare for systemic shocks, right? So you have to understand all these things, guys. Then, are your concentration risk identified? Bank must monitor concentration risks across your industries, your geographies, your borrower groups. Example is too much lending to one conglomerate can threaten the entire bank, right? Then you need to understand that the bank have sufficient risk data or not. Good decision making requires good data. Key risk indicators include exposure trends, your concentration trend, delinquency rate, loss provision. Evaluate these matrices. The board cannot evaluate risk, right? Without these matrices, the board cannot evaluate your risk. Okay, that you need to understand very, very carefully. All right. So now we go to another practice question. The credit risk management capacity review process should include what? Staff diversity metrics, information available to credit loan officers, a list of all loans denied in the last 3 months, timeliness of information flows from loan officer to the board, right? If you look step by step, right? Credit risk management capacity review includes what, right? Staff diversity metrics, no, right? This is an HR metric, not a credit metric. Management review the not a credit risk metric, which management review, right? Information available to credit loan officer, again, it is incorrect. Why incorrect? Because the review focuses on information reaching senior management and the board, not just your loan officers, right? List of loans denied in the last 3 months, again, wrong because the review examines application versus approvals, not specifically a list of denied loans over a short period. Option D is timeliness of your information flow. This directly relates to the information flow component. The review must ensure accurate and your timely credit information reaches your senior management and the board. So the correct answer is timeliness of information flows from loan officer to the board. The key FRM takeaway here is that credit risk management capacity depends on your lending process, your staffing, your information flow. And the board responsibilities, the board must monitor your loan pricing, your portfolio diversification, your model accuracy, your stress testing, your concentration risk, right? Now, why this topic matters is because many banking crises, right? Many banking crises happen not because models were wrong, but because the information did not reach your decision makers, your awareness was weak, risk concentration were kind of ignored. So this is why your Basel regulations emphasize governance and risk oversight, right? So we understood this, and then we go ahead, and this is the solution, the last part of the chapter. The credit risk management capacity review process should include the lending process, staffing, information flow concern. Consensus data should be gathered on staff, included number of people in the risk management function, their ages, their experience, and the specific responsibility. Diversity metrics may be captured by HR, not in this review. Within the lending process, it is useful to understand credit application related to approvals of the last 12 months. The key part of information flow analysis is to understand if accurate, timely, and cost-effective data and making it way to the senior management and the board. Okay, so that's what we need to know. Okay, so that completes our this chapter, guys. Little bit lengthy chapter, I would say, right? A lot of small stuff, right? But a lot of theory, right? It's not a difficult chapter without any calculation, right? So it's more about only two modules, but lengthy modules, right? So you have two modules: credit risk policies and credit asset classification. Then we have loan loss provisioning and your credit risk assessment, right? So both are lengthy modules. If you go through them, right? Uh, 7 topics in the credit risk policies and credit asset classification, elements on effective lending policy, setting your exposure, lending policy, review of loan portfolio, review of bank policy, credit loan classification, non-performing loans, right? All these you have to do step by step, right? Very step by step, slowly you have to do, right? And a lot of theory, right? Try to remember it. I think make some mnemonics, try to remember it. It's mostly a test of memory here, guys, right? Rather than anything else, right? So once you have seen this, okay, so okay, this is we have gone here, but in between you have model 2 also, again 7 topics. Loan loss, provision, and reserve. Expected loss versus unexpected loss. Expected loss under IFRS 9. Managing loss asset. Credit risk analysis. Credit risk management capacity. Key question for the board of directors, right? So that is what we need to understand, right? Yeah, lengthy topic, guys. Very lengthy topic. Go back, revise it, study it, twice or thrice. Practice the question, make some mnemonics, get a flow chart, how things are related to each other, remember the steps, right? It's mostly a rote learning kind of chapter. You have to remember it. Logics are less, mostly memory and the steps, right? So beware of that, right? That's it, guys. That's it from my side in this chapter. I'll see you in the next chapter. Okay. All right, guys. Thank you.